Tonight, you're going to check your bank account. You always do. Maybe it's out of habit, maybe it's out of dread. But somewhere in that number is a secret most people never find because they quit looking 3 months too early. The real answer isn't about how much you make. It's about a single exact number and what happens the moment you cross it. Here it is. If you invest $300 a month, that number is $51,429. Below it, you are the engine. Above it, the market is. And the gap between those two states doesn't grow slowly. It explodes. Let's start with what most people believe. They believe wealth is built the way a paycheck is built. Work harder, earn more, watch the number climb in a straight line. That's true for your salary. It is almost never true for your savings. Money, once it's invested, doesn't grow in a line. It grows in a curve. And for a long, frustrating stretch, that curve looks exactly like a flat line, which is why so many people give up right where the good part was about to start. Warren Buffett didn't become one of the richest men alive by picking stocks nobody else could find. He became rich by staying invested for longer than anyone else was willing to. Of the roughly $130 billion he had built by his late 80s, more than 90% of it arrived after he turned 65. Not because his strategy changed, because time did what time does when you leave it alone. He once put it simply, his wealth came from living in America, some lucky genes, and compound interest. 3 ingredients. Only one of them is available to you, but it's the one that matters most. So what actually is compounding? Strip away the jargon, and it's this. Your money earns a return. Then, next year, you earn a return on your money and on last year's return. The gains start generating their own gains. At first, this feels like nothing. $10,000 earning 8% a year makes you $800. That's a nice dinner out, not a fortune. But keep going. By year 20, that same starting pile, left untouched, has more than quadrupled. Nothing about your effort changed. Only the shape of the curve did. Now here's where the napkin math comes in. Every investor has 2 forces working for them at once: their own contributions and their portfolio's growth. In the early years, your contributions are the strongest force in the room. You're putting in $300 every single month. Your existing balance, still small, isn't generating much on its own. You are doing almost all the work. But your portfolio's growth doesn't care how small it starts. It compounds on whatever is there every year, whether you're watching or not. Eventually, the growth on your existing balance overtakes the size of your monthly contribution. That's the tipping point. The napkin formula is almost embarrassingly simple. Take your monthly contribution, multiply it by 12, then divide by your expected annual return. For $300 a month at an 8.4% historical stock market average, that lands you at roughly $51,429. Cross that line, and the market starts contributing more to your account each year than you do. Does that mean the first $51,429 don't matter? The opposite. They matter the most of any dollars you will ever invest, because of a strange, counterintuitive fact about compounding. A dollar invested early is worth more than a dollar invested later, even when the later dollar is much bigger. Here's the proof. Imagine 2 savers. The first invests $200 a month starting at 25, then stops entirely at 35. 10 years of contributions, then nothing else. Ever. The second waits until 35 to start, then invests the same $200 every month until 65. 30 years of saving, 3 times as many contributions, 3 times the money put in. At a 7% average return by 65, the person who stopped at 35 usually ends up with more money than the person who saved for 3 decades straight. Not because they were smarter. Because their dollars had 30 years to compound instead of 20. Time did the multiplying. Effort barely mattered. This isn't a theory. Fidelity, one of the largest retirement account providers in the country, once studied which of its accounts had performed the best over a set period. The winners weren't the accounts with the most trading or the cleverest picks. Many of the best-performing accounts belonged to people who had forgotten they even had one, or who had passed away and left the account untouched. The living, active traders underperformed the dead and the forgetful. Left alone, money does something people rarely do. It stays calm. So, Why does almost everyone quit right before the curve bends upward? Because the first climb feels pointless. Picture three rungs on a ladder. The starter floor, somewhere under $10,000, where your balance barely moves no matter how disciplined you are. The middle rung, from there up toward that $51,429 line, where progress finally becomes visible, but still feels slow. And the catch fire rung, above the tipping point, where the account grows almost on its own, sometimes gaining more in one strong year than you contributed across the entire previous one. Most people never make it past the middle rung, not because the math fails them, because 3 or 5 years of slow, invisible progress feels like proof that it isn't working. It is working. It's just working at a scale too small yet to notice. Jack Bogle understood this better than almost anyone in finance. In 1975, he founded Vanguard on a strange, boring idea. Instead of trying to beat the market by picking winners, just buy the entire market and let time do the rest. Wall Street mocked it. Index funds were nicknamed Bogle's Folly. Decades later, that boring approach manages trillions of dollars and has quietly outperformed most actively managed funds built to beat it. The lesson wasn't picking the right stock. It was staying in the game long enough for the curve to bend. Here's the part that should feel uncomfortable. If the tipping point for $300 a month sits around $51,429, then every dollar you invest before you hit that number is doing more long-term work per dollar than every dollar you'll invest after it. Not because early money is magic, because it has more years left to compound. A dollar invested at 25 has 40 years to grow before retirement. That same dollar invested at 45 only has 20. Same dollar, half the runway. Often, dramatically less than half the outcome. Which raises the real question. Not how much can you invest today, but how much time can you buy back by starting now instead of later? Because the $51,429 line isn't really about hitting a number. It's about crossing a threshold where patience stops feeling like sacrifice and starts feeling like leverage. Think about your own account for a second. Maybe it's near the starter floor. Maybe it's already climbing the middle rung, close enough to that tipping point to almost see it. Wherever it sits, the math hasn't changed since Buffett was a teenager buying his first shares, and it won't change for you either. The slow years aren't wasted years. They're the years buying you every year that comes after. Consider what changes once you cross that line. Before it, a bad year in the market feels personal. You put in $300, the market took some of it away, and your balance barely budged. After the line, the math flips. A strong year can add more to your account than your contributions did all year. A weak year barely dents a balance that size. The volatility hasn't gone away. Your relationship to it has. There's a reason this tipping point catches so many people by surprise. Nobody feels a threshold. There's no notification, no milestone, no moment where the app tells you the market just took over. You only notice it in hindsight, usually a year or two later, when you look back at old statements and realize your balance grew faster than you remember contributing. Compare that to how the earliest investors actually behaved. Not the legendary ones. The ordinary ones who ended up wealthy almost by accident. Study after study on long-term retirement outcomes points to the same quiet pattern. The people who ended up furthest ahead rarely made dramatic moves. They didn't time the market's bottom or sell everything before a crash. They simply kept contributing on a schedule, ignored the noise, and let 2 or 3 uneventful decades pass. Boring, in this game, is not an insult. Boring is the entire strategy. That's the twist most people miss when they imagine what building wealth looks like. It doesn't look like a founder mortgaging a house to launch a company. For almost everyone who builds real wealth through the market, it looks like nothing happening for a long time, followed by everything happening at once. The nothing is not the absence of progress. It's the progress, quietly compiling while you were busy living your life. So think again about where you actually stand, not where you wish you were, or where a headline says you should be by now. Just the real number, whatever it is. If you're below the tipping point, you're not failing. You're doing the heaviest lifting your money will ever require of you, and it gets lighter from here. If you're above it, the machine you built is already running without you. So tonight, when you check that balance again, Look at it differently. It isn't a number telling you how far behind you are. It's a number telling you how close you are to the point where the market starts working harder for you than you ever worked for it.